Today, we're going to speak about the mindset and methods of raising capital. My name is Eli David. I'm the co-founder and CEO of StartupBlink.com, a global startup ecosystem app. This is my email. If you have specific questions after the presentation, feel free to approach, and I'll try to answer them. Twitter, you can find us at StartupBlink. Topics for today. We're going to do a quick introduction. I'm going to tell you a little bit about myself, my startup activity, and then we're going to go to the more important part, which is basically specific topics relevant to raising investment for your business. So let's get to it. First, a little bit about lifestyle. It's always fun to start with a little bit of fun stuff. So basically, I'm a digital nomad. It means that in the last 8 years, I've been traveling and working in the same time. This map is not updated. I've been living in more than 40 countries, traveled in more than 60. By living, I mean I stay 2 months, and then I move to the next place, and then to the next place. Until a week ago, I was living 2 months in Russia. Now I'm living for about a month and a half. I'm planning to stay in Estonia. So I'm now in Tallinn in Estonia. If we have someone in Tallinn, let me know. We'll get coffee. And basically what I'm doing is I'm staying in a location for 2 months, doing co-working. I'm also now in a co-working space and moving to another city or another country. That's the advantage of kind of having a startup in a way. So yeah. Moving on to, and I forgot to tell you, I also have a blog and podcast. So if you're interested more in the topic of digital nomadism and how to travel and work in the same time, I'm sharing with you in the chat the link to the blog and the podcast. So pretty interesting if you're kind of interested in the little bit the lifestyle. I'll just tell you also that we also have a Telegram group that I forgot to share with you, that you can always connect with us. I'm also sharing another link with you in the chat. There are about 350 people in the Telegram group already, and it would be great to have you with us over there. So if you're into Telegram, which I know a lot of you are not, but that's another thing. Okay. The lecture is based a little bit on my experiences from a few things. The first thing is freelancing. So I've been freelancing a lot. I've been preparing business plans for about 4 years until 2014. My clients raised more than $3 million. I'm not doing business plans anymore, so if anyone has a business plan, I'm really sorry, but I'm out of the game. A very interesting career, by the way. You learn a lot, and I want to tell you something interesting about my business plans. Now that I think about them a little bit in retrospective, I've had dozens of clients, and I think 90% of them never really launched their project. What am I telling you? Basically, the statistics, again, the statistics are that the vast majority of people the statistics are that startups are incredibly difficult. That's the statistics, and I want you to remember this. This is a tough ride. It's a fun ride as well, but the statistics are, it's really tough to start something from scratch and kind of make it happen. So that's something that I've seen also in my career. Other than that, I also worked for a very long time on LingoLearn, an online language school. This is a cash flow business. And on StartupBlink.com, that's currently my main project, a technological startup. I want to tell you in general, as a side note, something that I think is my notion, because you've seen I have a little bit of lifestyle and so on. I truly believe that bootstrapping is the way to go. So if you're asking me and by bootstrapping, I mean not to raise investment. So if you're asking me what is the best case scenario for an entrepreneur, I would recommend if you can do it on your own without investment, do it on your own without investment. So that's kind of a little bit of a friendly advice that I hope is useful for you. But then again, sometimes you must have investors. So that's kind of a thing to remember. And again, if you have any questions, feel free to send them over in the QA, and I'm going to get to them. Okay, so my first business is StartupBlink. StartupBlink is an online language school. Very basic business. It's basically a landing page, and that's pretty much it. And we sell online. And I want to tell you a few things that I've learned while doing StartupBlink that might be relevant to you, especially in the context of receiving investment. So the first thing that I learned in LingoLearn is the following. First of all, you don't need a lot of money to start. We only invested $5,000, and you have a startup. So even today, it's even less. That was about 8 years ago. We couldn't get investors for the business, so we took a small loan and basically capped the loan. So sometimes you're going to be stuck, and you're going to be in a situation that you don't know if you can continue or not, and probably you're going to use a lot of your credit, because if investors are not funding you, it's only you. In the end of the day, we're going to speak about this as well. The sad thing in LingoLearn, I think, is that we tried too much to get investors, and it was not an investable business. And I'm going to explain to you as well what investors are looking for, because one of the things that I see as a tragedy of startups is kind of, let's say, selecting the wrong strategy. And if you have a startup that does not appeal to investors, and you spend a lot of your time as a co-founder, as a founder, raising investment, you're in the wrong place. And by the way, if you have a startup that you must receive investment in order to succeed, and you're not spending enough time in getting investors, that's also a tragedy. So it's very, very important to know where you are. The first investor and the only investor that we had in LingoLearn actually came in 2015. He was one of our suppliers. And the lesson here is that sometimes investors are going to come to you. And honestly, I think it's the best way, if they're coming to you instead of you chasing them. There is something, I want to say in general, investment is very, it involves this topic a lot of psychology, because it involves people. And you have to take into account that there is no one truth that is always the case, because you're actually, when you're trying to raise investment, the vast majority of your energy is with other people as well. So there is no one recipe that always works. So you have to take this into account. And the idea that I have on LingoLearn is basically that for that kind of business, and I'm going to explain exactly why, when I'm going to talk about the interests of investors, it was not worth the time to look for investors. If you're building something like LingoLearn, a landing page and an online business school and whatever, and it's relatively local and so on, do it on your own. That's basically the conclusion. Some projects do not have any reason to look for investors. And if you're looking for investors when you have a project like that, you're wasting your time as a founder. This other project is a little bit different. This is StartupBlink. You probably arrived to this webinar via StartupBlink. It's a meetup. So we have a lot of meetups. We have about 90 meetups around the world with about 40,000 members. So you're probably part of our meetups, and it's really great that you joined us. Global startup ecosystem map, tens of thousands of registered startup, co-working, and so on. There is a lot of technology involved here, a lot of investment of time and also of money. It's not as simple as a landing page of basically what I showed you in LingoLearn. This is a little bit more technologically complicated, and that is a very, very good indication that on a project like this, you do need investors. So that's kind of a thing that I wanted to tell you. We're very focused on community in StartupBlink. One of the things that we do, which I think can be very, very interesting for this topic, is research. So we're doing a lot of research of ecosystems in StartupBlink. We're trying to figure out what are the best cities and the best countries with the best startup ecosystem hubs and centers. You can see this, by the way, if you can register on StartupBlink, that would be great. It's totally free, www.startupblink.com. I'm also going to write to you in the chat. And one of the things that we do there that might be really, really relevant to you is the research. And the research is ranking 1,000 cities and 125 countries around the world according to their startup ecosystem strength. If you go to the link that I gave you, startupblink.com, you can scroll below the map, and over there, you can kind of search for your city. And let me tell you why is it important. It's important because if you're looking for investors, you want to make sure that you're in a hub. If you're looking for investors outside of a hub, It's very suicidal, to be honest, because investors are very much focused in geographies and in centers. So my advice to you would be the following. If you're building a startup and you know raising investment is a must for you, make sure that you're in a place that is an ecosystem center. And unfortunately, and I'm saying it not with a lot of joy, if your place is not really an ecosystem center, a startup ecosystem center, and you know that you must raise investment, go somewhere else. And again, I'm sorry, I know everyone loves their city and whatever, but there are specific places where investors are. So of course, it's much easier to raise investment, and you can see here just a screenshot a little in San Francisco, in New York, in London. So let's say if you're now in England and you're in the south, in Portsmouth, and you know that you must get investment, go to London. If you're currently in somewhere in Alabama and you're building a massive project, go to New York and San Francisco. If you're in a small town in Germany, go to Berlin or Munich. Basically, that's my advice to you. You need to know where you are. Where is the city that you're ranked in? And this is a really good tool to know that. So just below the map, you can have a look and see if you're going to have to say to your city goodbye forever. Actually, I'm now in Tallinn. I just met someone today that told me that according to our research, they decided to move to Tallinn because Tallinn is a big hub, and they only understood it after they saw the map. So it's pretty nice to see how we influence lives with things that we build. And also it's very cold here, so I'm kind of hoping that we didn't do damage here. I think it would be more happy in Thailand, but that's another thing. So again, the conclusion is if you're raising investment, where you are is critical. Go to a place that is a startup ecosystem hub, okay? So that's a friendly advice about the location that you pick. Few lessons from StartupBlink. So basically, it's a global startup ecosystem map. It's a big vision. If it's a big vision and you're building a tool that has a lot of technology, you probably want to do it with investors. It's very hard to commit such amounts of money on your own. We did receive an initial seed round that made us build this project. And the conclusion with StartupBlink is exactly the opposite conclusion from LingoLearn, is that in some projects, you will not be able to do it on your own. You're going to have someone to take the risk with you because it's going to be too much. So one of the secrets here is to know what kind of projects are you building, and according to that, your strategy, it changes a lot. And startups are so difficult that you as a founder, you must understand what is the correct strategy for your business, and it's confusing. It's nothing easy. I still get it wrong all the time. So, but you know, we try. That's the best we can do. Before I go to this slide, let me have a quick look on the QA just to see if we don't have any questions, and I'll be right with you. So Mark is asking, what are your views regarding raising funding or different business models? For example, raising money for property business versus product-based startup. Very, very different. You can never really have one strategy. I will say, again, what I said before, if you can avoid raising investment, avoid raising investment. If the risk is too big and you know that you need a lot of money to start, raise investment. You don't want all the risk on you. So that's basically the thing that I would take into consideration. Let's talk a little bit about why bootstrapping is sometimes best. And when I'm saying bootstrapping, I'm meaning you building your startup without taking $1 from investment. And why is it so appealing, actually? So first of all, I want to tell you the following. If you raise money, it's going to be your full-time job. There is no, hey, you know what, I'm looking for money and I'm going to work 95% of the day on the product and so on, and 5% I'm going to dedicate. Raising money is a full-time job. Usually, if you have a team, usually you isolate one person that only does that, because it's also a manic depressive period, I have to tell you, because you schedule meetings, people don't show up, people tell you yes, people tell you no, and it's like you don't want this person involved in the life of the project. So if you are a few of them, usually you isolate one person and just tell him good luck. But the thing is that it totally takes out the focus on working on your product, which is the most critical thing to do. So that's one disadvantage. Another disadvantage is that chances are against you. You saw the poll. The poll was 4 of you found investors and 47 of you are looking. And those are actually good numbers. The idea with investors is as following. If you don't know the right people, it's going to be extremely difficult to find investors. Okay, so you're really, really dependent on your network. Okay, so that's critical. Now, one more thing I want to tell you. If you don't have the right profile, it's also going to be difficult to raise investment. So for example, if you have a profile like mine, a digital nomad, traveling the world, moving from Russia to Estonia and every 2 months or whatever, really bad. Because investors do not believe in this profile of a traveling person, let's say. I want to give you a guess. Do you know what is the best profile for startup investors? Maybe you can take a guess in the chat. I am just interested to see what your intuition tells you about what kind of people are going to be in the best position to raise investment. Just to see what you're thinking. Okay, we have one from Aubrey. Interesting. Nice. Okay. The winner, we have one winner here. Definitely, it was also the first of you who answered, Aubrey. Harvard dropouts, living in Silicon Valley full-time, or some kind of Ivy League dropouts. So investors, basically, you have to understand something about investors. They're people just like you and me, only with money. Now, the minute that they have money, basically, they use a lot of generalization of what worked. And if you look at what worked in Facebook and Google and all those guys, those are people that got accepted to Ivy Leagues and then just dropped out after a year. So if you're a dropout from an Ivy League university, you're amazed. You're gonna have much easier time. But if you're a person like me, out of the norm, doing some kind of a lifestyle thing, you're not. So each one of us kind of have to take a look on ourselves as well, on who we are, and kind of understand if we're currently on the right track currently. So I have to tell you, if I would try to get investment, I would probably settle down in Tel Aviv and just live there and try to kind of normalize my life. So it's important. And usually it's also, there is a bias, a little bit of a bias to younger people, the dropouts, they just left and full with passion and they don't have kids and families so they can dedicate 100% of their time. Do know that investors think that way because it's proven that statistically it's kind of a little bit better. The other things that you said are also relevant. If you have tech experience, if you've succeeded before, that's critical. Doesn't matter if you who you are. If you've succeeded before, it's going to be very, very easy to get investment. So that's basically interesting, a little bit of ideas here. So a little bit more reasons of why you don't want to raise investment. We talked about it. Chances are against you. You have to have the right profile. You're no longer your own boss. You have to report a lot of what you do to other people. You're no longer only you in the business and you can do whatever you want. You have to report to people. You have to share the decision-making with people. One more thing to consider is that investors might not be that much fun to deal with. You have a new partner. And if this partner and you don't get along, it's going to be kind of depressing, you know, getting emails from your partner, hey, you promised me this and you're a failed investment. It's going to destroy your day. So it's very important, by the way, for you also to trust your intuition when you choose an investor, if you're lucky enough to be in a position to choose an investor and kind of say, am I going to have fun with this person? It's going to be a good experience. In some cases, mainly VCs, venture capital, you can get fired. I've seen a lot of people getting fired from being the CEO, and there is always in the contract with VCs something that they can overthrow you. Investors will always push you towards liquidity, which means, let's say you have a business and you're making $20,000 of profit a month and you're super happy. If you don't have investors, you would stop and be happy. If you have investors, you can never stop because your investors are expecting you to kind of fill in for all the bad investments that they've made. So if your product is taking off, you have to continue, all or nothing in a way. And that's the game with investors. So that's a big disadvantage. Also, I want to tell you that too much money can be very, very distracting. Let's say your product really sucks and nobody will ever buy it, and you have an investor that is kind of irrational enough to give you money to fund you for 2 years. It seems amazing, but actually it's the worst thing that can happen to you, because now you're going to spend 2 years of your life building something that makes no sense. So sometimes it's not really good to take investment if the market, if you haven't tested the market. And delaying investment will get you a much higher valuation. This is another thing to consider. It relates to what we talked about before. If you run after people, people don't like it. When they run after you, it's much better. Okay, so the idea is that it's psychology in the end of the day. So those are some reasons of why you shouldn't actively look for investment. However, in some cases, you must look for investment, and that's the confusing part. So basically, most startups lose money in the first 3 years. Or even if they don't lose money, they're not even going to get you close to your salary, the salary that you expected or what you earned before. Investors can keep you floating in a way. So it makes a lot of sense to kind of use their money while you're putting the effort to sustain yourself and your business. It mitigates risk in case of failure. So let's say you're already putting your best years and you're putting a lot of effort. If someone is putting the money, at least you don't lose your money if this thing goes down. It allows faster growth and scaling. You know, you figured out something, it works. You see that you sell in your town. If you want to go to city and national level, you're going to have to invest a lot of money. If you're bootstrapping, it's going to take a lot of time. If you're using money from investors, you can go internationally very, very fast. So the idea is to run fast. And it also creates barrier of entry. Because if you're going to run very, very, very fast, you're going to conquer the market, nobody can get in. So for example, Facebook. Facebook is not such an amazing technology. You can kind of program Facebook in a few months. But the thing is that they ran so fast that everyone is using them now, and they have a barrier of entry. Google Plus that tried to enter with maybe a better platform had no chance, because nobody wants to go on something that already exists. So the idea is if you're onto something really, really good, you have a very small window of opportunity to conquer everything. And that's what investors are for scaling. And I also want to tell you that some investors are really smart money, and they're actually really great. So other than the money that they give you, they can give you connections. They can connect you with your future investment. So basically, some investors are going to connect you to your next round of investment. They can connect you to clients. They could connect you to potential team members, strategic partnerships, and so on and so on. So there are many reasons to actually find this smart money. And smart money means that they have a lot of knowledge, so they can give you a little bit of guidance as well and help you with strategic decisions. So smart money is great. So it's a little bit confusing, but there are reasons for having investors, and there are reasons for totally avoiding them. And again, everything has to do with who you are and what is it that you're building. A little bit about risk and debt. We talked about investors reducing a little bit your risk. So this is a funny quote. If you think nobody cares if you're alive, try missing a couple of loan payments, and you're going to see people care. So the idea is that reducing the risk, basically, and kind of using other people's money. A quick graph that is very, very interesting. This is a graph that shows where does the money for startups arrive for. And you know, I think that intuitively, if most of us would have to guess where the money is coming from, we would probably say it's coming from the investors. But this is not the case. You see the first column. The first column is personal credit and savings, which means that the startup founders, are actually funding most of our startups. So nobody's doing it for us. In reality, a lot of it is our money. We have to be very, very careful with this, not to jump over what we can put, but a lot of it is expected to come from you. And you see a very big column here, which is the column of family and friends. And this is a column that is very substantial. We're going to talk about it because probably a lot of you that are going to raise investment, in the end, are going to end up in this column. And it's a little bit sad, but it's also good. And we're going to speak a little bit about how to deal with that. And then you see the other columns, venture capital, angel investors, are big, but they're not really big, you know? So it's kind of interesting to see. Crowdfunding is relatively small. Okay, this is a quote by Paul Graham, the co-founder of Y Combinator. Raising money is second hardest part of starting a startup. The hardest part is making something people want. But the second biggest cause of death is probably the difficulty of raising money. Fundraising is brutal. So remember, we talked about this. Fundraising is basically almost a full-time job, and it's difficult because you're trying to take money from people. Never easy. Uh, that's something to think about. Let's talk a little bit about why would investors want to get in with you and invest and give you money. This is important because I think that a lot of us, if you ask us this question, would say, that's easy. They want to receive a good return on investment and get their money back plus a lot more. But this is not necessarily the case. There are many, many other reasons of why people are looking to invest. And I want to tell you that you have to make sure you understand why is it that the person you're talking with wants to put money, because it's going to totally change your dialogue with them. And there are many reasons. So here are some of the reasons that I can think of. The first and the biggest one, they want their money back plus, like to make a really good profit. Other than that, they're trying to diversify their portfolio of assets. So, now the interest rates are really, really low, which means that startup investing became trendy. People are putting money in startups. It's totally okay. Others are looking for fun and excitement while helping to create something new. So even if they know that they're not going to make giant amount of money or whatever, but it's exciting to help a new startup of people trying to build something new, they would want that. They get to their 50s, 60s, and so on, and they want in something new and exciting. So if they do, try to promote it when you speak with them. Others are interested in creating positive social impact. And the idea over here is that they kind of want to do something that influences the world, that kind of makes a good influence of the world. So if the person you're speaking with is interested in this, you have to explain to them, hey, my startup of drones that is bringing coffee to people with a drone is also, if coffee is left, is giving the rest for poor people or whatever your idea is. But some people are really interested in good social impact. So not a lot of investors, but some of them are. And that's going to be your wild card to get them. Some people want to actually take a more active role in the business. So if you tell them, hey, we're going to speak once a week and I'm going to get your advice and whatever, that's going to be even more important to them than the potential money that they're going to receive. And some people just want a story to tell, in their dinner, Friday dinner, when they sit down with their friends and family. Hey, I just invested in this drone coffee business, and it's a great story, and people think that you're interesting, and so on. So the idea is, do try to understand what is the psychology of your potential investor when you speak with them, to kind of know what to say. Not all of them are obsessed about money and the returns. So that's kind of something to take into account. Okay, so moving on to what do investors want to see in co-founders? And again, if you have any questions, you have a QA button. I'm not looking at the chat, I can't. So basically, if you have any questions, feel free to shoot them in the QA button. What do investors want to see in the co-founders? This is important. Why is it important? Because if you're not there, try to delay getting investors until you're there, okay? So the first thing and the most important thing that investors are looking in co-founders is co-founders, okay? So the idea is that if you're looking for professional investors and good investors, the vast majority of them would really not be happy if you show up alone and you don't have any co-founders. Why? We talked about this before. They look on generalizing what worked before. With all the guys that made it big, the vast majority of the companies that made it big had co-founders. It was not relying only on one person, because companies that rely only on one person are very fragile and not that, let's say, sustainable. So getting a co-founder before you raise investment is important. The other things that they want to see is unquestionable commitment. One of the things that investors most are scared of is a situation in which you're going to tell them, you know what, thanks for giving me the money, but 4 months after, we're out. We're no longer commitment. So they're trying to see the enthusiasm in your voice because they're scared of you ditching the project when life is becoming a little bit difficult. Investors are also very interested in a good proven working relationship between co-founders. They know that a lot of startups are dying because of conflicts within the team. So for them, if you can tell them, hey, me and my co-founder, we've been working together for 3 years already, and we met 3 years ago and we worked on, so then they kind of know that this is not fragile. But if you tell them, hey, I just got a CTO, we actually met only 20 days ago, then they're kind of saying, okay, this is a potential risk of a relationship because I don't know how you guys are gonna, let's say, what's gonna be your relationship if things get tough. So it's something that investors kind of look at. Investors also want good chemistry with you. Just like you want to have fun with them, they want to have fun with you. So if they feel like they can trust you and they kind of have fun with you and kind of like enjoy speaking with you and consulting you and so on, they're gonna stay. If not, not so much. There has to be total trust in the founders. So when you're speaking with investors, you want to make sure that they don't catch you on anything that is not true. So it's better to make them see that your startup is not interesting than have them kind of say, you know what, that's not really true. Like it doesn't make a lot of sense. Trust is critical in investment. So maintain your trust. Make sure that it's also your brand. So make sure that your word is a word. They also want to see a team with broad range of skills. So for example, if you're a marketing person and your other co-founder is another marketing person, that's kind of like they would think to themselves, why is the team so diversified? Where is the salesperson? Where is the coder? Where is the expert on the algorithm or whatever? So you have to think about this as well. And of course, investors always like to see previous startup experiences, including failures, but not so much. To be honest, everyone is telling us, hey, failures are cool and just fail. And that's, no, investors are much more interested in success stories. So if you have a success story on your belt, much better than 5 failures. So just to make sure that we're on the same page. We talked about the Ivy League dropout. That's kind of the profile that they're also looking for. It doesn't mean you have to be an Ivy League dropout, but again, it comes to the point that there are a few profiles of people that they know that the ROI is good. So if you're belonging to one of those groups, it makes their life easier. I'm going to go to the QA for a second, see if there's anything relevant that I can quickly answer, and then we're gonna move to the next thing, which is basically what do professional investors want to see in the business. So we talked about but first of all, I want to answer a quick question. Anonymous attendee is asking how to advertise yourself as a co-founder. You don't want to advertise yourself as a co-founder. The most important thing, if you ask me, about getting to co-founders is the following. First of all, network. Go to as many events, know as many people that you can, not when you need the co-founder, before, okay? That's also good. And the second thing, build something cool. If you build something cool, you will attract co-founders. If you're gonna have an idea and you're gonna speak about it, not so much. So that's like a little bit of quick advice. Good. So we talked about what do investors look for in a team. Let's talk a little bit about what do professional investors want to see in the business. So I want to tell you a few words about spray and pray, but some of you are from America, so you kind of should know about it. Someone can tell us in the chat a quick summary of the spray and pray strategy, investment strategy. I'm interested to know if someone knows in a sentence or two, what does it mean exactly? And then I'm gonna tell all of you about it. I'm gonna use this to have a small water break, so just a minute. Let's see if we have a winner. Beautiful. So Lenovo said it right. Basically, the 1% success offset the 99 failures. because they became unicorns. So the idea is as following. If you invest in 30 startups, 29 of them burn, nothing is left, and one is a Facebook or a Google, you've made crazy amounts of money. And the idea is that because unicorns, which are over $1 billion startups, are worth so much, one success story can kind of cover 29 total failures. So why does it relate to you? So if you know that this is the strategy of the professional investors, you have to make sure that when you speak to those investors, they know that in the best case scenario, and they also know that there is 1 or 2% chance of this scenario to happen. That's okay. You don't have to tell them why 100% is going to work, but you have to demonstrate to them why, if the best scenario happens, you're going to be huge. Okay? So the idea is that if you have a business, an online language school business, and the best scenario is kind of make $10 million of revenue a year, not interesting, because they're going to say, no, this is not an investment that's going to cover all my failed investment. So you kind of have to think about a big market. You have to make sure that your demand is substantial. This is only if you're going for investors. If you're building a lifestyle business, not relevant at all. You can have a small niche in a small market and do amazingly good profit. But if you're trying to go for professional investors, remember the spray and pray. And that means that if they make a hit on your startup, in the best case scenario, your startup is freaking amazing, and we're talking about hundreds of millions of dollars. Okay, so you have to kind of prove to them why, in the best scenario, this thing is going to be worth hundreds of millions. Investors also want to see barriers of entry, which means basically that new entrants will find it very, very difficult to join the market. So you have to kind of tell them not only, hey, this is working and so on, and I have signs that it works. You have to kind of also tell them, you know what, it works, and if we go fast enough, we're also going to win. And they need to understand why is it that your company is going to win, and what is the defense that you've got against new entrants, okay? And of course, investors care at minimum of having a prototype. Don't dare to go to investors with an idea. Please do not do that. You need a prototype. You need something that you can show milestones. I've achieved that. I've done that, and so on and so on. Do not go to investors without clear milestones and ideas. That will end horribly. You could have done it maybe 10 years ago. Now, no, not anymore. And in many cases, or I would say the vast majority of cases, you also need to show them traction, which means a lot of people interested already in what you're building, not the market, in what you're building, and revenue as well, which is, of course, a validator of demand. And of course, they're going to be interested as well in who invested in you before. They don't like to be the first one to take the risk. The first one is always more difficult because they're like, I'm the only stupid person here. Nobody else made the decision. So they kind of want to see who joined the rounds before, who is joining now. So do know about that. I'm going to have a quick look at the QA before we move on. So let's see if there are any relevant questions. So just a second. Okay, so Matilda, interesting question, but I think it's a little bit too long. So see my email in the end of the presentation, and I'm going to try to answer to you via email so I can take a deeper look and study a little bit the case. And Conjo is asking, what is the minimum level of investment to warrant a massive potential market startup? Good question, no clear answer. Depends. If you're building a screening machine for hospitals, it's going to be giant. If you're building something else, it can be relatively small. The idea is that you don't need to get all your investment in one go, but just get a part of it. Show that you reached milestones, then get another part in a higher valuation, and then another part in a higher valuation. So even if you go big, it doesn't mean that you have to receive all the money. That's why companies keep on raising money. Okay, we're going to move to the next slide, which is basically major factors to consider when negotiating with investors. I'm going to speak a little bit about it. I think it's irrelevant. I think the really interesting part is for you to understand what investors think. But one of the things that you always going to consult with investors is the valuation, how much money, how much you're going to get diluted, how much money are they going to put on which valuation. You need to make sure that there is a shared vision with the investor. You need to make sure that you're going to still have an ability to make decisions. And you also need to agree on how do you communicate with them. What's the frequency of updates and so on and so on. Now, I want to tell you a little bit about valuation because I know this is a topic that is very interesting for people. I think it's unnecessarily interesting. I'll tell you why. It's not a game. Nobody's trying to cheat anyone else. The idea is that you have the interest of giving the right valuation and the investor as well. If an investor is tricking you into a very, very low valuation, it does two things. It's going to reduce your motivation a lot, and you're going to have too little money, because if the valuation is very, very low, the money is low as well. So the idea is that investors don't, especially the professional investors, they don't have any reason to save a little bit of money on the valuation and make you feel like you've been cheated. So it doesn't really work. Now, on your side, I want to tell you that you as well don't have any need to increase the valuation to unnatural heights. Why is that? Because of this word that is down round. So the idea is, I'm going to give you an example. Let's say someone tells you, hey, I want to give you $100,000. What is the valuation? You decide, whatever valuation you want. Let's say you tell them, you know what, my valuation, you're going to tell yourself, my valuation is around $3 million, but I'm going to tell them 10 million, because just to give them only 1%. So let's say they say, okay, you spend their $100,000 and you have to spend money again, to raise money again. And then when you go and try to raise money again with more professional investors, they're going to tell you, what's your valuation? You basically had a valuation before of $10 million that you gave 1% of the company for 100K. You're going to have to go and do a down round. And investors, new investors, really don't like a down round, because they're going to say, really? Like, you thought you were worth 10 million, now it's only 5 million? People don't like businesses that go down. And your investors from before is going to be really upset, because they're going to tell you, why are you raising money in $5 million? You took from me a valuation of 10 million. So the idea is, valuations are really not important. Try to be fair. You're going to be fair. Your investor is going to be fair as well. Okay, so it's just a few thoughts about valuation. And I'm not going to go over this. This is valuation methods. There are many, many valuation methods. I'm just going to tell you the biggest valuation method there is. How do you know your valuation? Check what are the relevant valuation of investments that were made already, to make it not complicated, because kind of like say, okay, these startups doing exactly the same. They raised money about 5 months ago. That was their valuation. It's a good milestone for you to have. And also, it really depends on who you're raising money from. If you're raising money from venture capital, like Sequoia and so on, and you come to them and tell them, hey, I need $100,000, even if they're crazy about your startup, they're going to throw you away like crazy, because they never invest less than 2 million, you know? So the idea is also make sure that, basically make sure that whoever you speak with, what is the money that they usually invest and what is the equity that they take, and that's exactly what they're going to take for you. So the idea is, you don't need models, you don't need financial DCF, discounted cash flow, and so on, the things that I've done for my clients and so on. Now it's a little bit more intuitive. So kind of like a quick view. There is a little bit of a lingo when it has to do with investment rounds. You need to know it, because you're going to be asked, and you kind of want to, as a founder, to show that you know what you're talking about. We're not going to go over it a lot, but just for you to know, there are a few investment rounds. One is pre-seed. Pre-seed is when you're trying to build something, some kind of a prototype, some kind of you're trying to hire the first person and so on. Usually over there, the amounts are between 40K to 100K. Something very, very basic to build something initial, you know. Other than that, you have a seed round. A seed round is a little bit more complicated, and it's all the way from $150,000 to $2 million. This is relevant for companies that already built some kind of a product and are trying to figure out their product market fit. So that's a seed round. And then after that, you have Series A to Z. It can go all the way to Z. Those are usually 2 million to 15 million. Sometimes with unicorns, it's like 10 billion, you know, so you never know. That's the rounds where venture capital are usually in the series. Their venture capital firms are kind of interested for the angel investors and your friends and family to fund you in the pre-seed and the seed, so they can go in the series when it's getting serious. Some sources of funding your startup. So let's go over them. I want to focus on the first one. The first one is the most relevant one. Some people tell them free F, the free F investors, the club of free F, which is basically friends, family, and some people add fools. I don't agree. I think it's basically it should be friends and family. To be honest, I was totally against getting money from family and friends about 2 years ago, but now it seems like a very good option because I see that a lot of successful companies are actually doing that. What can it be? It can be college friends, it can be family members, and so on, people that know you. Usually, when you take money from family and friends, you do that in small amounts, between $10,000 to $100,000 in relatively low valuations. They're the first one to go in. The nice thing about them is that they invest in you because they trust you. They know your characters, they know your intentions and goals. They actually have an unfair advantage to professional investors. Professional investors are going to meet you and they don't really know who you are. The friends and family, they kind of know you. So they have an unfair advantage of information, which is important. And I want to tell you that friends and family are a good sign for angel investors and more professional investors. Because if you're going to an angel investor and you're telling them, look, nobody ever invested in me, not even my family and friends, it's kind of like, really? Like you have a big network and none of them was interested? So nobody's going to look down on you if you have investors from family and friends. They're actually going to say, okay, you have skin in the game. Now you have something to prove. And you're also not going to bail out on me because I know that as a professional investor, you might not care about me. But if your uncle or your sister put money in the project, you're probably going to fight for it. And that's exactly the signal that those investors are looking for. The advantages of taking money from friends and family is that there is minimum due diligence. Usually they will not ask for crazy business plans and stuff like that. It's going to be relatively easy, short negotiations. They usually don't meddle in operations. They trust you and they just tell you, hey, do your best thing and tell us the good news. And so basically there are a lot of advantages here. There are also disadvantages, of course, needless to say. Usually it's not smart money, which means that your friends and family usually cannot really give you a lot of advice on the market, the industry, strategic decisions, and so on, and can't really connect you to valuable resources. If the startup fails, people that you care about are losing money. Not fun at all. And it might also affect your personal relationship. You're going to have very awkward dinners and holidays. Holidays are coming, so it's kind of like awkward holiday dinners. You have to think about that. Those are things that you have to take into account. My advice about friends and family as investors. 2 years ago, I would tell you don't go for it. Now I'm going to tell you go for it if you can. However, make sure that they know the statistics. By statistics, I'm talking about what are your chances of success as a startup. So I would tell them the following. I would tell them, look, I'm building a startup. I'm going to do my best. I really, really think we have an amazing shot. But you should know that generally 90% of startups fail. Okay, so this is kind of an information that they deserve to know. Okay, don't surprise them later when they lose their money and tell them, hey, but 90% of startups fail. Why are you so upset? They need to know in advance. The other thing that you want to make sure is that the quality of life that they have will not suffer if the investment is gone, okay? So the idea is, let me give you 2 scenarios. Your aunt has $200,000 in the bank, and she's going to give you just before she's retiring, she's going to give you $100,000. Don't take the money in this case, because if she loses the money, that will greatly influence her quality of life. Another example, your uncle has $2 million in the bank and they want to give you 100,000. Okay, why? Because if they lose the 100,000, it's not going to make a big impact on your life. It's not going to be very awkward meeting them in the holiday dinners. So always try to make sure to understand what is the impact of losing that money for them. So that's kind of like a little bit of advice on those guys. And before we move on to accelerators, anonymous attendee is asking about dealing with legal stuff, like try to find good startup solicitor. You're probably gonna need a lawyer if you're gonna reach investors. Then you're in a good position because you basically managed to be in a situation that you're now negotiating. So I do advise to have a lawyer when you close a deal. And I also advise when you close a deal, of course, have a registered company, which is also important because investors will not do a deal usually with a company that is not registered. So yeah, you have to take care of the technicalities for sure. But the real tough part is actually to persuade people and not the legal stuff. Okay, so moving on to accelerators a little bit, let's speak a little bit about accelerators. Accelerators are programs that usually give you a little bit of money, up to $50,000, and mentorship in exchange for a small amount of equity and 3 months of you studying with them. Very interesting entities. Let's talk a little bit about the advantages of accelerators. First of all, knowledge. Some accelerators, and the important word here is some, will give you mini MBA. It's not all of them. That's what I meant. They're going to have amazing mentors that are going to give you valuable information about fundraising, about UX, about marketing, and so on, that is going to be incredibly valuable. So the lower your knowledge is, the lower you feel like you have knowledge, the best it would be to go to an accelerator, but a good accelerator. Network, accelerator, the good ones. Again, I'm keep on repeating because accelerator is one word, but they divide into really great ones and not so really great ones. So the good ones are going to give you networking. They're going to connect you to their network. The network usually is going to be lots of potential clients and a lot of potential investors. So good accelerators have amazing networks as well. And they can connect you to your next investor. So there are many, many advantages in joining an accelerator. Validation is also important. Let's say a big accelerator like Techstars or Y Combinator accepted you. By definition, you have a very interesting mark that people are saying, okay, the investor, if this accelerator got you, I don't need to think too much. They already validated you. So it's a very good milestone to share. Money, some of them are going to give you small money, which is going to be enough to kind of move a little bit forward. And also there is an advantage of joining an accelerator, which is basically motivation and fun. Startups are usually very lonely. So spending time with other entrepreneurs can be very motivating as well. So it's something that you should take into account. However, accelerators also have disadvantages. Let's talk about them. First of all, the variance. Not all the accelerators are good. Some of them are really, really bad. They're going to be a total waste of your time. And if they take your equity, not smart. So you have to make sure and do your due diligence. Who are the accelerators? Who are the mentors? What startups participated before? Make a call to those startups. Tell them, hey, I saw that you joined this accelerator in the June batch. How was it? They're going to tell you the truth. So that's something that you want to know. It's your time. It might be a little bit of your equity. Do due diligence. Some of them are going to ask you to relocate to the hubs. I honestly think that it's good because most of the accelerator are in the startup hubs. And some of them are going to take your equity. A little bit usually, but still, every piece of equity counts because until the journey ends, you're going to keep on being diluted. So make sure you're getting diluted for good reasons. Okay? So that's basically a little bit about accelerators. Let me see if there are a few answers that I can maybe answer on the QA. So just a second. And we're going to continue. I'll also check the chat. Someone is asking about co-founders. I know that the topic of co-founders is very interesting. When looking for a co-founder, I've been told we need to be in the same place to be credible. How true is it in practice? Usually it is true, but not always. Meaning that if you can tell the investors, look, I've been having this co-founder and we're on calls every day and we're building great things together, it's no longer that critical, but it is an advantage. there are a few tricks about co-founders. For example, I don't know if you know, but what kind of co-founders people avoid? You want to take a guess in the chat. I'm interested to see if you there is a specific co-founders that are together that investors don't like. So I'm wondering if some of you in the chat can guess what it is. Yes, exactly. Couples. So the problem with couples is, of course, that they can have fights and then it's all over in the same day. So yeah, there are a few things to think about co-founders, but yeah, remote co-founders are going to be more and more, let's say, acceptable. But yeah, it's better if you're with your co-founder. I'm going to tell you something in general. I'm working remotely with my team for a long time. It makes sense to be together in the same room and work like crazy on a project. There is a special element here. So as much as I like remote work, yeah, being together in the same place makes sense. Okay, let's talk about other options. We talked about friends and family. We talked about accelerators. There is also the options of angel investors. I don't have a lot of advice on angel investors because they're so different from one another. There is not even one good profile of angel investors. Some of them are amazingly good, smart money. Some of them are going to make your life depressing. So they vary a lot. And then you have super angels that are basically, or syndicates. You can find syndicates on AngelList, boutique VCs, and so on. They're putting a little bit, the rounds are getting bigger. And of course, in the end, that's the venture capital. The people are looking for IPOs, traded companies, to make it big in the stock market, in the Nasdaq, and so on. The idea is to know that when you're small and you haven't shown much, go for the angel investors, for friends and family, for syndicates. And then when you want to scale, when you want to build something giant and you have really, really good proof that what you have is incredibly promising, venture capital is your best way because they're well connected. I also want to talk about another thing is basically strategic investors with corporates. This is also very lucrative. Corporates like Microsoft, Samsung, and so on are now entering into the startup scene and they're investing a lot of money in startups. One of our best partners is actually, we're partnered with the ANSI Startup Program, a big company in the USA, amazing people. And the idea over here is that sometimes corporates are going to invest money or are going to partner with startups on different goals, strategic investment, partnership, building a product together. The good things is that basically corporates have a lot of money, so they have the resources to push things if they see it's logical. The negative thing is that sometimes big corporates are going to have totally different culture than your startup, and it's a little bit difficult to work this way because the corporates are kind of playing it safe. You're as a startup founder, you just started, want to run as fast as possible. So there are a little bit of cultural differences. But if you find a really good partner, totally manageable. That's something about corporates and their accelerators and so on. They shouldn't be ignored. They're really, really an interesting option. This one I'm gonna skip a little bit and let's talk a little bit about the practical things because we have very, very low time left. A little bit of practical tips. How do you find your investor? I would tell you that probably in all probability, you already know them. They're inside your network now. The chances of you finding an investor that you don't know and persuading them in a matter of 1 or 2 months to give you money are relatively low. And the second bullet is introduction is key. I think most of the investors currently will not even speak with you if you send them an email, even if the email is interesting. They would need you to be referred to them by someone else. And that means that basically you want to ask relevant contacts that you have to tell them, hey, do you know any investors that you can introduce me to? Or if you are interested in one specific investor, try to find someone that both of you know, because introductions are key. And some of the investors are actually saying, look, if you can't find a way of getting to me via someone I know, don't waste my time. It's actually a proof that you as a founder can solve problems. So I want you to be aware of this. How do you get introduced to those guys via your network is critical, much more critical than sending cold emails. I do want to tell you that one of the things that is very, very understandable here, if you're looking for investors and co-founders, is to go to events, mingle, and build your network. Your network is so critical. like so critical, and you have to keep on constantly working on it. One of my tips for network is co-working. So I'm doing co-working wherever I go, and I found the most amazing people on co-working. Do not work at home. And if you work at home, go to events, go out, meet people, because if you don't know people, you will not get connected to investors, and you're also not going to find co-founders. On co-working, on the topic of co-working, I'll just tell you that basically you also want to find a co-working space that is geared towards startups. The best one currently in the world is, probably you all know them, WeWork. And WeWork is also giving a discount to our members of up to 15%, and basically a free tour as well. So have a look at WeWork.StartupBlink. Send you. This is the link to this. But the idea is go and do co-working because it's critical. And the idea is do not stay without a network. Okay, that's really, really important. Other than that, other relevant tips that might be worthwhile to you. Just a minute, I'm going to go back to the presentation. LinkedIn is a great tool. So sending emails, getting a premium account on LinkedIn, you have to pay them a little bit, is really good because it allows you to jump over the gatekeepers. So that's pretty cool. Mentors. I want to tell you something about mentors. Mentors are good in connecting you with investors, and your mentors can be your investors as well. So the idea is that there is a saying, if you're asking an investment from someone, they're going to give you advice. You know, hey, I thought about it, but I can't help you because X, Y, Z. But if you're asking someone for advice, they're going to be emotionally invested in how this thing can work, and then they might invest in you. So basically, the idea is to be in a situation to get mentors to kind of help you out. And I now remember what is the link. It's basically wework.startuplink.com. So this one should work, hopefully. Yeah, so that's basically it. Let me see if I have any other tactical tips here. Press. Getting press can be very, very important. So the idea over here is that if the news is speaking about you, I've seen it all the time with StartupBlink, investors are attracted to you. So if you have a quick way of getting a little bit of press and articles written about what you do, something interesting, for example, you ranking all the countries and cities in the world, you're a digital nomad traveling 60 countries and so on, you're going to be in the press, and investors need that because for them it's a sign of validation, a sign of momentum in a way. So it makes sense to kind of do that. Let's see if we are really, really close to the end, but I'm going to give you a few quick tips of how to reach, more tips on how to reach investment, although I already told you my first tip, introductions. Try to figure out who is in your network and introduce you. You will never know before you ask. So ask people, hey, do you know any investors? Can you introduce me to this person and so on? Or if you specifically know who is the investor that you might be interested in, try to figure out how you connected to them. Go to LinkedIn, see if maybe there's second connection, who is the connector there, and ask for a connection. So one thing that I recommend doing, which is a quick hack, is to follow the blog or the Twitter account of the investor and kind of comment in their blog. So basically investors are very funny because a lot of them are, they have a blog and nobody is reading their blog, but everyone wants their money. So if you're gonna comment and show interest and create some kind of a personal connection between you and them, you're much, much better off. Okay, so that's one thing to think about. And if you're gonna create conversations with them on Twitter and so on, amazing. This is exactly what you need. You need to be in a situation that they're receiving 20 or 30 emails a day. Try to create some kind of personal connection, either via an introduction or show interest in what they do. Don't be a stalker, but show interest in their blog, in their Twitter, start a conversation. There are many, many lists of investors on Google. So you can check, for example, and investors, by the way, are very local. So what does it mean? If you're currently in Lithuania, you don't want to find an investor in San Francisco. You almost have no chance. The idea over here is that you want to find investors in your city and country. It's relatively easy to find lists. For example, in Israel, if you're going to see list of investors in Israel, you're going to see amazing resources with emails and everything. Someone already did the work. So those things exist. And one more thing that is recommended is that to keep in touch with all the investors that said no to you. And try to send them an update, an email every 6 months, every 1 year. Hey, this is what's new in the startup. What does it show them? It shows them that you're super persistent, that you just don't give up, and that's what they like. So the idea is once every 6 months, send them an update email of, hey, I'm hoping I can take a minute of your time to update you. Even if they told you no in the past, you don't ask them for investment. You're just telling them what is new in the company. And it works in many, many cases. Let me jump to the QA just to see if there is a quick question that I can answer now before we run out of time. Tom is asking, is it possible to raise money for an application idea which is not developed? Probably not. So today, in today's world, no. You're gonna have to, you're not supposed to develop the application, but you're supposed to develop something that resembles what you want to do and kind of tell them, look, my application, what I'm planning to do is XYZ. I did this. It solved the same pain, and I have 2,000 people that subscribe and pay me $1 or even just do something. So the idea is do not go to people with an idea. By the way, a lot of people are afraid that people are going to steal their idea. Build something, and then nobody's going to steal it. But if it's only an idea, you know, you're vulnerable. So that's something to kind of think about. But you're not really vulnerable. Share your idea. Talk about your idea whenever you can. But the thing is, execution is so much more important than the ideas for investors and for anyone, for your co-founders. People have to put this in their head. It's not your idea. Your idea currently is shared by 50 people around the world. There are too many of us. Everyone thinks about the same things. Even if you think that you hit something that is amazing, it's all about how you make it happen. Lagiera is asking about what about crowdfunding? Crowdfunding is a reasonable option. However, I showed you in the chart, it's only 5% of the money currently. So it's nice, but it's in very relevant projects that are usually hardware, physical products. So it might work, but it's not really going to be the thing that usually helps company to sustain themselves, because the margins there are also very, very low. So it's good, but if you can do it, I would do it. Yeah. Arun is asking how to find senior mentors. Good question. Try following people that you really enjoy hearing their opinion, that are influencers, and you can ask them, hey, I really enjoyed this article. You don't ask them, hey, be my mentor. You kind of stay in touch with them and give them feedback of what they're doing. Give before you take. That's the idea. Try to help them. How do you help them? You know, and then after helping them, you're in a position to kind of tell them, hey, is it okay if I can ask you a quick question about something? And then it's going to be okay. But if you're coming out of nowhere asking for advice or favors, not so cool. Benny is asking about incubators. If I'm not mistaken in the translation, incubators are good. They're good as well. Usually they don't give money, but it's a really good step. Let me move on with the presentation, because we're actually a little bit above after time. A little bit about documentation. What is the most important documentation that you're going to need? Take a guess in the chat. Let's see if someone gets it. What's the most important piece of documentation that is relevant? Let's see who is the first one that gets it. I only figured it out after 3 years. So we have a few answers. Interesting. From my experience, all those things that you said are relevant, but from my experience, it's the elevator pitch, which is basically you have a few seconds with an investor. What do you tell them? That's the most critical thing that I see that many people fail. Like, you have to be in a really situation that you're saying, I'm building, hey, we're both in an elevator. I'm saying, I'm building a startup ecosystem map and a research center. We have tens of thousands of registered startups, and we're ranking all the countries and cities in the world according to the startup ecosystem strength and working with big organizations. Boom. It took about 15 seconds, and I kind of shared an image of my startup. This is the critical ones, because those are the opportunities. When you get the attention of very high-profile people and of investors, you don't have a lot of time. you need to make it extreme. They're not going to give you 2 minutes of their life for you to explain to them what you're building. So the elevator pitch is important. Practice on your elevator pitch. Executive summary is much better now than a business plan. One pager, only one page, a PDF. What is it that you do? What was achieved until now? The team, problem, and solution. And then when they invite you to a meeting, a slide deck, which is basically a PowerPoint. Okay, or something else. I'm sorry, PowerPoints are a little bit old, but that's my generation. This one is very, very tactical, so I'm gonna skip it because we're late. So I'm gonna hopefully do another presentation, kind of mix the time better and be faster. And that's my last advice to you, this one, which is basically the best way to get investment is to build something amazing that people need and use. The minute you do that, you're gonna the most important part over here, and that's the easiest trick. It's not easy, but that's the biggest trick there is. Build something amazing, people will love it, and then investors are gonna come to you. It's not always possible, but always think about this. This is a good thing to think about. And basically, that's it for today. This is my email. So for everyone that I didn't have a chance to answer in the QA, apologies. Feel free to send me your question to Eli at StartupBlink.com. Register a startup at StartupBlink.com if you can. And yeah, and do co-working, WeWork.StartupBlink.com. And basically, you get a discount there. And that's basically it. It was really fun. You're very active. Thanks a lot for all the questions. It was fun. Happy holidays. Most importantly, take a break. Think about your startup in January. This is the time to kind of enjoy it and get recharged. And hope to see you in the next Startup Link talks. We're going to do one hopefully every month. So it would be good to see you and keep in touch. Thanks. I'm going to stay in the chat with you a little bit and then going to head home. So thanks a lot. Thank you.